Good morning, everybody. Thank you for coming out. It's nice to have a good full house. There's quite the line downstairs, so I hope everybody moved through quickly. I'm Ben White, Politico's Chief Economic Correspondent, author of the daily Morning Money newsletter. Hope you read it. If you don't, see me afterwards. We'll sign you up. I can deliver it personally to your house if need be. Thrilled to be here again in New York City at the NASDAQ market site in Times Square. Thanks to all of you who are here and everybody joining on the live stream. This is Politico's first New York City event series. Throughout the year, our America's Fiscal Future programs, we're examining how policy, politics, and national trends are influencing the current fiscal landscape and the future of the national economy. Today, I'm honored to have former Chairman of the U.S. Federal Reserve, Dr. Ben Bernanke, for a timely and important discussion here in New York City. Hope all of you have gotten his book. It's a tremendous read. If you study the period of the financial crisis, it's essential reading, and the history of the Fed. It really is quite captivating for those of us who live and breathe this stuff. So I highly recommend you get a copy of it. Before jumping into the program, I'd like to thank our sponsor, NASDAQ, for their support of America's Fiscal Future and hosting us here at Market Site for these important conversations. Before we jump into the program, here to say a few words is Hans Ole Jakobsen. He's the president of NASDAQ. Hans.
So good morning and welcome to NASDAQ Market Site, our storefront to the world, where we open and close the markets every day. So we are here today for the third event in our live series we co-produced together with POLITICO on American fiscal future. In NASDAQ, we are of course also very grateful that our special guest today is now free from the constraints of the Federal Reserve Banks to comment freely and openly on economic and fiscal issues. We can all surely benefit from Ben Bernanke's wisdom and insight, particularly as America returns to a more historical, normal economic and political situation. And we are all curious about what's next. You will soon be in the able hands of Ben White, Politico's senior economic correspondent and our moderator for today's conversation with Chairman Bernanke. But let me first say that the return to normalcy we are seeing is not a foregone conclusion. The persistent uncertainty in the global economy, the volatility we saw in August, mean Mr. Bernanke's former colleagues at the Fed, along with the Congress and the Obama administration, must walk a fine line to ensure America's long climb back. And if I may steal a phrase from the title of Mr. Bernanke's new book, it will take acts of courage from all of us to ensure the return. So, NASDAQ is pleased and proud to be part of these important discussions on America's fiscal future, and we are so happy that you have elected to spend our morning with us. With no further ado, let me introduce Politico's Chief Economist Correspondent, Ben White, who will now moderate the morning for us. Ben, please.
Thanks, Hans Ole. Thanks so much for those words and for your sponsorship of this series. We look forward to more great events this year. And I want to encourage folks who are following on the live stream or here, you can tweet the event with the hashtag #AmFiscalFuture. And let's get started. I want to introduce the former chair of the Federal Reserve, possible future baseball commissioner, Dr. Ben Bernanke. Thank you so much for joining us and taking the time. I want to start a little bit with current politics in Washington, D.C. and a potential fiscal crisis that faces us relatively soon. Once again, Congress is having a difficult time with the debt limit. It's not clear yet whether a clean debt limit increase can get through the House of Representatives. We've got, according to Treasury, just till the first week of November, so time is growing short. I wonder if you could talk to us about the potential consequences if we get both close to or past a debt limit deadline. What could that do to markets and to the economy right now if Congress is not able to, with alacrity, pass a debt limit increase?
Sure. So people need to understand what the debt limit is, first of all. It's not about constraining spending. It's about paying the bills. And if the debt limit isn't raised, you know, the government can't pay Social Security, can't pay military, can't meet its obligations, and very importantly, from a financial point of view, beyond a certain point, it would not be able to pay the interest on the national debt. And of course, since Treasury securities are the most liquid base financial security around, that could have obviously very disruptive effects on the global economy, the global financial system. So what we've seen in the past, we've come pretty close in a few times in the past, and the markets generally tend to discount it until the last few days because the assumption is always that it'll get done. But, you know, I think the risks have risen. The political paralysis has been such that you really can't count on things getting done in a timely way. And if we get close to the point, we'll begin to see disruptions in markets like we saw the last couple times, 2011 that happened. And also potentially effects on the economy. For example, when the United States was downgraded the last time, we saw impacts on consumer spending, consumer confidence. So it's a very negative thing for our financial system and for our economy. That's describing what happens if we get close to it. If we go over the line, and if there really were to be a default in the national debt, it would really be unknown territory and very, very dangerous situation.
Do you have any sympathy with the argument that Republicans sometimes make, and they're going to try to put forward a bill this week that would prioritize payments, pay the interest on existing bonds, military, certain other payments, while not making others? Do you think it's conceivable that the federal government can pay certain bills and not other bills?
Well, there are some practical issues. I mean, the Federal Reserve, actually, we did a lot of contingency planning for this when I was chairman because the Fed actually makes a lot of the payments, processes the payments, but not all the payments come to the Fed. Some come from other parts of the government. So I would be at least somewhat worried in that case about, from a technical point of view, about making it happen in the way that this bill envisions. And the other thing to say is that, you know, maybe the immediate effect within hours of not paying a Social Security check is a little different from not paying interest on the debt, but it's also a default. It also represents a failure to meet obligations, and it would go into the U.S. credit rating and so on. So I really think that, you know, we ought to pay the bills. Yeah,
and do you think markets would react to a default on other payments in a similar way it would react to default on an actual existing debt obligation?
Well, I think the debt obligations, frankly, would be worse because it would immediately affect, you know, financial holdings and create a lot of confusion. One of the things we found out was that the computer systems, they don't have a button for default on the national debt. You know, I don't think they could really handle it. So I think that would be extremely disruptive, but it would be disruptive in any case. And again, I strongly advise against it. It's really not the right way to make the arguments that, you know, the substantive arguments. It's fine to have debates about government spending and all these other issues, but this is not the right tool.
Yeah. Let's pull back the lens a little bit from Washington, although obviously a crisis on the debt ceiling or on any of the other fiscal deadlines coming up in the fall and winter could damage the U.S. economy, which is not exactly moving very quickly. There are some economists now who are increasing their odds of a recession coming to the United States, you know, by next year. And I wonder, in your review of the data, both unemployment, all the other economic data coming in, how would you categorize the risk of recession in the United States right now?
So it should be said that economists are really, really terrible at predicting recessions. And
take your best shot.
There are a lot of false alarms. You know, it can always be a shock. There are concerns now about the global economy, what's happening in emerging markets, how they're going to react to Fed tightening and so on. But I guess I would say that looking at the fundamentals of the U.S. recovery at this point, there's not much there that's signaling recession. We still have slack in the economy. We don't have an inflation issue, which has been the source of recessions in the past. You know, the housing sector, for example, which is often the driving force behind cyclical dynamics, it's still in a relatively, you know, middle of a recovery type phase. So there's a lot of domestic momentum in our economy now. The main risks are international, but there's nothing to me that suggests that a recession is a high risk, other than the fact that the average growth rate has been relatively low, and so you're a little bit closer to zero than we would be if we had a 4% economy. But you know, that internally, it looks like the U.S. economy has a good bit of room to run at this point.
Right. And in terms of those international risks, obviously we had a significant impact from the tumult in China and the Chinese markets, which carried over into the United States. Still some issues in Europe continuing to be a risk to the United States. How would you categorize what are the biggest risks externally to the U.S. economy, and can we weather those without much significant damage to ours?
Well, you know, during the crisis, everybody went down together. It was a global event. Now we have a bunch of different stories around the world. You know, Europe and Japan are different stories. I think the biggest risk, and there's pretty much general agreement about this at the IMF and elsewhere, would be emerging markets at this point. They have not responded quite as well to the slowdown in China, even though there was a predicted slowdown as was generally hoped, and there's some financial risks. There are a number of countries like Brazil and Russia which are having particular stress. Emerging markets are about half the world economy now. Both financially and in terms of growth, I think that's where the greatest risks are, in part because we don't have as much information understanding of them as we do about the advanced economies. So that's where I would identify it. But the fact that Europe is still quite slow, Japan is quite slow, China is making a transition to a slower growth rate, none of that really helps that much, obviously, but the most uncertainty would be in countries like Brazil.
Obviously, the biggest market focus over the last few months has been on the Federal Reserve and the timing of a rate increase. I know you're sensitive about talking about decisions that Chair Yellen might make in the future, but you have commented on the decision to hold at the last meeting as the proper one. I wonder if you could talk about sort of the dilemma that the Fed faces right now. Markets are discounting an increase this month, and now even in December, the odds I think in the futures market are down to 30% or below. There is obviously desire on the part of the central bank to have liftoff and to move into a more normal monetary policy, but there are no indications of inflation, and we have some slowing in employment growth. It just seems like an exquisitely difficult time for the central bank right now. Not as difficult as what you went through in your tenure, of course, but in terms of policy, very difficult. Describe what you think the Fed needs to be weighing now, and do you think it's time to move away from the effective zero interest rate policy?
Well, I don't want to second guess Janet's very tough decision, but I can tell you what they're looking at and what they're thinking about. I mean, it boils down to kind of a risk management kind of decision. You know, the arguments against action, or at least for going very slow, are that, as you say, there's no inflation yet. The economy is growing, but it's not booming. There are some risks internationally, which are the primary drags on our recovery right now. And from a risk management perspective, the risk of going too soon, whatever that might be, are enhanced by the fact that we are at zero, interest rates are close to zero, and so if, in fact, the economy does falter and you have to come back to zero, you don't really have as much space to ease as you would under more normal circumstances. So there are definitely some risks in that direction. The Fed, though, has also talked about the risks in the other direction. The basic model of inflation that the Fed uses is really the only one that economists have, is the so-called Phillips curve model. And it says basically that as the amount of slack in the economy gets used up, that inflation pressure will eventually begin to show up. And we do have unemployment at 5.1%, and despite relatively weaker numbers last couple of months, unemployment is still moving in that direction. And the argument would be that at some point, wages and prices will start to pick up. And what makes it difficult, you can say, well, we haven't seen inflation yet, and it's true, but what makes it a harder calculation is that monetary policy works with a lag. It takes 6-9 months or even more to have its effect, and therefore there's a need somehow to get ahead of the curve a little bit. So that's where the debate is right now. I think I would put inflation in the very center of that debate. Is inflation about to take off, in which case policy needs to be preemptive, or do we have time to wait and be cautious because of the zero lower bound and a weaker global economy.
And is there any real way to answer that question? I mean, you talk about the Phillips curve and the only tools available to look at inflation and where it's going, and those in the dovish camp would say, what are you talking about in terms of inflation? There's no indication that it's going to start building anytime soon. The Fed is, or the hawks are tilting at windmills here, and that the real problem is wage growth is not what we'd like it to be. There's still a very low workforce participation rate, so nonsense to talk about inflation. But as you say, there's a lag in policy implementation and its impacts. How serious are the risks of the Fed getting behind inflation?
Well, you just sort of stated the dovish case, which is that we haven't seen much yet. So, you know, it's hard to judge. I mean, that's what they're grappling with. This is why, in my opinion, you know, there's people have talked about putting in a computer or automatic rules to make these decisions. I think, you know, they're tough decisions, and nobody can make them perfectly, but I think you do need human judgment to look at the range of factors here. And again, there's, if you look at the models would tell you at this point that, which is all they have, the models would say at this point that unemployment is getting very low and slack is being eaten up, and that would suggest that inflation should appear sometime down the road. But then you've got sort of the Larry Summers view that you sort of wait to see the whites of the eyes of inflation. Again, I don't want to second guess Janice. I'm being a little careful about that, but that is really what the debate is. You know, is there more slack? Will the economy slow because of global forces, and will that, you know, mean that inflation is really something that's down the road? And it's about risk management. It's not, you know, the Fed actually forecasts that inflation won't get to 2% until 2018, right. But as Janet Yellen talked about in her press conference, of course, there are the scenarios in which the economy goes faster and gets hotter and inflation moves quicker than that, and those are the ones that she's trying to head off. Yeah.
Well, let's talk about the other tools at the Fed's disposal if we stay at the zero limit bound and no increase is made this year or even in the next year, and we do get more of a slowdown, and we do get the unemployment rate either stalled or going back up again and wages not rising. The issue of negative rates, could we do that? Is there room for more quantitative easing, which Republicans in Congress are not going to want to support? What tools are at the Fed's disposal if indeed we stay at zero and the economy slows down?
So, you know, so if that happens, which we hope it won't happen, obviously, there are things the Fed can do. The first and best thing they can do is go down to Capitol Hill and say, please help us with fiscal policy, right. Because
good luck with that.
Good luck. When monetary policy is at its limits there, then fiscal policy can be extremely helpful. But if we don't get that, and if you do get a significant slowdown that requires a response, there are things the Fed can do, but none of them are incredibly attractive. So what obvious thing they could do would, you know, just the fact that they're not going to raise rates and say, you know, in that contingency we're going to stay at zero, and we think we'll stay at zero for a long time, that kind of communication, right. That would certainly have effects on markets. So that would be sort of the first thing to do, obviously. Beyond that, there are various tools. You know, Europe has demonstrated that negative rates are possible. We didn't think that this was a very good approach because we were afraid of the impact of negative rates on money markets and other institutions, and we didn't think it would give very much oomph because rates can't go that negative. Well, maybe they can go more negative than we thought, as we've seen in Switzerland and other places. So mildly negative interest rates would be a possibility, and the first place to do that would be to pay negative rates to banks who deposit reserves at the Fed. Beyond that, you could imagine trying to peg rates over a longer period, like a 2-year rate. And ultimately, of course, you know, quantitative easing is there. I would hope that there would be more support in the situation where the economy really is needing help, and if the Fed could explain it. But notwithstanding the political situation, you know, quantitative easing is probably at this point less effective than it was in, say, 2009, as we have approached zero interest rates and as, you know, the term premiums have been taken out of long-term interest rates. So the fact is that the tools are not super strong, and it would be extremely helpful in that contingency to get a little bit of fiscal help.
Yeah. I want to switch a little bit to politics just for a minute because I saw this yesterday. Rand Paul, I think on CNBC, said he wanted to debate you about Federal Reserve transparency, audit the Fed, the other initiatives that he and other Republicans in Congress have championed to, in their view, make the Fed a more open institution. I know you talk a lot about, in your book, about making the Fed more transparent and moving to press conferences. I want to ask you, A, will you debate Rand Paul? we can get him up here. Maybe
you think
if
you
we
can get him up here?
Yeah, yeah. Cool. Secondly, if you won't debate Rand Paul, talk a little bit about your experience with the Audit the Fed advocates, the extent to which the Fed is more transparent now than it was when you got there, and are there measures that could be implemented that would make the central bank somehow more transparent to taxpayers and to Congress?
Sure. So I don't think I want to get involved in the Republican presidential primaries. So first of all, let me just say transparency of the Fed is really important. The Fed has made huge strides over the last decade, including press conferences, including, you know, I think it'd be hard to convince this audience that they don't hear enough about monetary policy.
Hard to convince me.
There's a continuous debate going on in public about what policy is going to be. The books of the Fed are completely open and completely to anybody who wants to go on the website. So I'm sure, you know, that we could think about ways to make the Fed more accessible. You know, you know, the chair can always do more public outreach. You can try to, you know, even increase further. But I spend about a third of my time in one way or another dealing with Congress in some capacity or another. But you could do even more of that. So I think there are things that the Fed could do as an institution, presumably to go even further to help the public understand what it is and what it does. I mean, you know, many people out there just don't even know what the Fed is still, right, even after all this has happened. So I think all that is valuable, and the Fed should continue to explore those things. I know that they're doing that. But, you know, the Audit the Fed, let me just say a word about that. I mean, I think this is a very deceptive, this bill is very deceptively titled, because the average person says, audit the Fed? I mean, you've got this institution with a $4 trillion balance sheet, and you're not auditing it? Of course they're auditing it. The financial books of the Fed are completely open. They're audited by an outside accounting firm. They're audited by the Inspector General. They're audited by the GAO. Congress has complete access to every element of the Fed's books, every element of its operations, with just one exception. And the one exception is that the GAO is not allowed to come in and essentially investigate individual policy decisions, right, monetary policy decisions. So that's the one thing that there's an exemption for, and what Audit the Fed would do is basically allow Congress to say, oh, well, we didn't think the Fed made the right decision in September, GAO should investigate that, ask for all the materials. You know, I mean, you're basically saying that the Congress should run monetary policy, right, and I always like to say, if you love the way they're managing fiscal policy, let them run monetary policy. So I'm totally open to having more open Fed, more transparency, more outreach. Terrific idea. A lot of that happens in local communities now, but I think they should retitle the Audit the Fed bill to the Congress Runs Monetary Policy bill, and then it would be a more accurate description of what it's about. Yeah,
I mean, what would be the outcome if in fact that GAO provision got reversed and Congress were able to, in real time, go in and get all of the discussions from FOMC meetings and publicize them in the short term, the negative impacts that would be?
It would obviously very inhibit decision-making and inhibit the policy choices, and I would give you a very explicit explicit example, which is when we introduced quantitative easing, the second round of quantitative easing in November 2010, we received a letter from Congress, from Boehner and some other Republican leadership, saying, we don't think you should do this, don't do it. And of course we did what we had to do, and I think it was the right choice. But you know, arguably the Congress could have stopped many of the tools that we used in the recovery, and I suspect that, you know, we would now be in a much worse situation than we are.
Yeah. Speaking of Republicans and their dealings with the Fed, I always wondered when Rick Perry made that famous comment about how you'd be treated roughly if you came down to Texas, what you made of that at the time, and have you had enjoyable experiences in Texas since those comments?
Well, so I didn't know how to take it exactly. I didn't think it was a very good sign in terms of Fed-Congress relations, I have to say. Although I remember telling a staff meeting that if this be treason, let's make the most of it. But I did actually, it happened by coincidence that a couple months after this comment, I had planned a trip. Richard Fisher, the Federal Reserve Bank president from Dallas, had arranged a trip for me to meet to Texas, and I went to Fort Bliss, which is an Army base in El Paso, and I met with the troops. I met troops coming back from Iraq. I met with business leaders. I went to Austin. I went to a bunch of places, and I had a great reception. So I was treated pretty well in Texas.
No posses were out looking for you at that
No.
point? Yeah, no.
I mean, I don't know where Rick was, but the rest of the state was pretty good to me.
Yeah, one place he wasn't is the Oval Office, but
Yeah.
in any event, sorry, Rick. Governor Perry. There's a lot of great anecdotes in your book. It's mainly, very serious-minded discussion of your background and time at the Fed and the crisis and the aftermath. But there's some good stuff about your personal story. I wanted to ask you about the time that George W. Bush talked about your socks. Tell us about what your relationship was like with the president, what it was like working in his White House when you were the CEA chair, and tell the sock story.
I had a very good relationship with President Bush. He was very supportive, even though the Fed took actions which the Republican Party in general didn't approve of during the crisis. But my relationship was enhanced because I spent some time. My only really political job in Washington was I spent less than a year as the head of the Council of Economic Advisors in the White House, and so I had a pretty good relationship. I saw the president pretty frequently. And on one particular instance, sort of once a week or so, the CEA would go into the Oval Office and make a presentation to President Bush and Vice President Cheney about what was going on in the economy, the latest data, that kind of thing. And so this was one of these presentations. I was in there, and I was explaining some economic data to the president. And he's just listening, kind of half listening. And then he leans over, and he pulls up my pant leg like this. And with my finely honed sense of sartorial elegance, I was wearing a gray suit like this and light tan socks. And he said, Ben, this is the White House. He says, we have certain standards here. and he said, what's with the tan socks? And I said, oh, Mr. President, I said, this is a fiscally conservative administration. I got these 4 for $10 at the Gap. And he laughed, and it was a jokey kind of thing. That was the way he operated in meetings. And so, we went on with the presentation. Well, the next day, I'd had some discussions with Keith Hennessy, who was the deputy director of the NEC. The next day, there was another meeting, and I was again in the Oval Office, and the president comes into the Oval Office, and every man in the room, including Vice President Cheney, was sitting like this, wearing tan socks. So it was a lighthearted relationship, and it continued. I saw him quite frequently after I became chair, and of course we had a lot to talk about because the crisis went into high gear in fall of 2007.
Right. Let's move off of socks onto breaking up the big banks on Wall Street. I wanted to ask you, there's clearly a debate in the Democratic Party right now, to a certain extent in the Republican Party as well, with populists and progressives continuing to suggest that financial institutions after the crisis are too large, they have too much of the nation's assets and should be broken up in one way or another. I wonder, obviously the Fed has a prudential responsibility to oversee the largest banks. In your analysis of this situation, is it true that banks have gotten too big after the crisis and that things need to be done to make them smaller and less risky, or is the increase in capital that these banks hold enough to protect the safety and soundness of the system?
Well, the increased capital and tougher supervision clearly makes them safer than they were before, but I think we still have to worry about size, complexity, interconnectedness, and what impact that might have both on the efficiency of markets, are they dominating the banking markets too much, and what risks do they present from a financial stability point of view. And the challenging thing is to simplify banks and make them smaller in a way that preserves, they actually provide important services to the economy, so can you do it in a way that isn't sort of like a blunt, way of doing it. And I think that, while it may not be fully appreciated, that a lot of what Dodd-Frank did and some of the other international agreements have moved us in a direction where we are moving towards a situation where banks are now evaluating their own size and complexity in light of the fact that, on the one hand, there are economic benefits to size, but on the other hand, it's becoming much tougher to be a big bank. Right. For example, GE Capital, General Electric, was divesting its financial arm because it didn't want to be a systemically important firm and therefore subject to Fed consolidated oversight. Some large banks are trying to shrink because they don't like the fact that the largest banks have to hold more capital than other banks. So by making it costly to be a big bank and making it, more tougher regulations, more capital, those sorts of things, you put the incentives in the right place and force banks to think about, whether their size and complexity is justified in an economic sense, or whether it's basically, can be dispensed with and you can get simpler banks. I think over time the pressure will be on banks to simplify. Yeah. The most important tool, and I need to say, is the liquidation authority that Dodd-Frank created, which allows the Fed and the FDIC to unwind firms after the fact, but also before the fact, to require them to simplify in ways that they could be unwound. So there's this living will requirement that every year the banks have to provide a blueprint for how they would be unwound, and if the Fed and the FDIC aren't satisfied, they can require them to get smaller, to simplify, et cetera. So I think there is, in fact, a process underway that will lead over time to a more rational banking system. But just breaking them into tiny little pieces, you're going to lose a lot of value if you do that without thinking about, what the economics is. And finally, let me just say that, in the 1930s, we had a huge banking crisis, and mostly small banks failed. So you can't even guarantee that with small banks that you're not going to have some problems.
I mean, I guess J.P. Morgan's attempt to sell its high-bridge private equity unit would be another example of these large banks trying to divest themselves of certain, I wouldn't say non-core, but parts that require them to hold more capital. On that same topic, the issue of Glass-Steagall reimposition is constantly one that's brought up in the Democratic presidential debate. Martin O'Malley, Bernie Sanders, both very strong supporters of reinstituting that division at banks. Do you have a position on whether that would be helpful at all in terms of safety and soundness?
I'm actually a little puzzled by the focus on that particular provision. There are many provisions, that you could look at. Glass-Steagall, of course, is the rule, the 1930s era rule that separates commercial banking, lending, deposit taking from investment banking, underwriting securities and the like, and that was repealed in the 90s. I think that if you look at the actual, what happened a few years ago in the crisis, that Glass-Steagall was pretty irrelevant to it because you had banks like Wachovia or WAMU that went bad because they made bad loans, and you had investment banks like Bear Stearns and Lehman that went bad because of their investment banking activities, and Glass-Steagall could have been in place. It would have had no effect on most of these firms. AIG would have been unaffected by Glass-Steagall. I think the only major financial institution that Glass-Steagall would have a major effect on is probably Citi, which still has some of the supermarket elements. But for the most part, I think it would just be an example of breaking up firms for the purpose of breaking them up without a clear rationale for doing that. I think there are other ways to simplify banks that would be more effective.
Yeah. You talked a little bit about in the book and more broadly in recent interviews about the lack of prosecutions of individuals following the financial crisis, the focus of the Justice Department on firms and banks and not individual executives. Obviously, it's hard to put a bank itself in jail, although I guess you could build a big enough jail to put a bank inside. But practically a difficult thing. I wonder specifically what executives broke laws, which laws did they break, and who is it that the Justice Department should have gone after and didn't?
Well,
I want you to provide me with a list.
Yeah. Well, I left it in my other pants.
Yeah. We could start.
No, what I was talking about there was really about prosecution strategy. I mean, what the Department of Justice did. So first of all, some people have gone to jail. I mean, some traders who rigged markets and committed fraud. And I think obviously, you should commit fraud. You should be prosecuted for it. I think my complaint was that I didn't understand, frankly. I didn't understand why the Department of Justice often chose to penalize large financial institutions, which basically amounts to penalizing the shareholders, rather than going after, you say executive, I didn't use the word executive, so you have people at all levels. You have traders, you have loan officers, you have executives, risk officers, and so on. In situations where there were civil or criminal culpability, then obviously that's something an individual does. It's not something that a fictitious corporation does. So I think it would have been more informative and possibly more fair if the Department of Justice had taken a strategy of looking for individual responsibility rather than corporate responsibility. I don't have, I think it would have been part of the process to find out where culpability was. you know, a lot of things that happened were you know, bad practices, irresponsible, but there's a line between being irresponsible and making a criminal act. Those are the kinds of distinctions and decisions that really belong to the courts and to the Department of Justice. So I'm not saying that, you know, we should have been carting off bankers in buses, but I do think that it would have been informative if there had been more analysis of where the individual responsibility lay.
Yeah, I think Senator Warren might like the idea of big buses hauling off a lot of bankers to prison. We'll present that to her. People are going to be mad at me if I go back to Lehman Brothers again. I say we've talked enough about the crisis and the collapse of Lehman and Bear Stearns. I personally don't agree with that. I think we could talk about it till the end of time. And you write about it very captivatingly in the book. And I'm still trying to figure out a little bit the decision-making process on Lehman. Obviously, they had a potential buyer in Barclays that fell through with the regulatory problems that they faced. But you know, Bear Stearns rescued into the arms of J.P. Morgan, Lehman Brothers teetering on the point of bankruptcy with potentially, well, I don't know at the time how catastrophic you thought the consequences of that would be. Talk us through the decision-making process to let Lehman Brothers fail when you actually had helped rescue Bear Stearns. Why was that done when Bear was rescued?
Well, it's very important, and I think we were right in the following sense. At the time of Lehman weekend, there was a pretty broad range of views which said that it was time to let a company fail. I mean, the editorial pages were pretty much take the weekend off, let the market do its thing. And I think we were right, ex post we were proven right, that we were very worried about what would happen, and we thought that it would greatly worsen the financial panic. And so we made an extraordinary effort to prevent its failure, including calling, you know, major CEOs, Wall Street CEOs of the Federal Reserve Bank of New York, and basically marshaling an institution-wide effort over that weekend. Basically, and the book goes into much more detail about this, basically it was not a decision, it was a necessity. We didn't have the tools we needed. With other institutions, we used 3 different tools. One of them was to have a buyer. So in Bear Stearns, you asked about Bear Stearns was bought by J.P. Morgan, and J.P. Morgan came in and guaranteed Bear Stearns' liabilities, and that solved the problem. The Fed helped J.P. Morgan, but J.P. Morgan was there to buy Bear Stearns, by the way, which it could not have done if GlassSteagall had been in place. So that was one way, buying. But in the case of Lehman, we had 2 potential buyers. We thought one of them would come through, but both Bank of America and Barclays, for reasons I can get into if you want, were unable were unwilling to make that acquisition, even with, you know, hints and promises of help from other bankers and from the Fed. So we couldn't do that. The second option was to put capital in, which is what we did with, you know, Bank of America and Citi later on. But this was before the TARP. Of course, Lehman's failure was the thing that essentially led to the TARP. So we didn't have any capital to put into Lehman. And the third option was basically Fed loans, which is what we did for a lot of banks. It was ultimately the way we saved AIG, because AIG was able to put up as collateral its subsidiary insurance companies. Lehman did not have the collateral. It was suffering a tremendous run. It was already losing not only its short-term funding, it was losing its customers. It was just falling apart, and it didn't have remotely enough cash, enough collateral to legally sustain the loans that I'm not even sure loans could have saved it, frankly, because we would have needed a buyer. But anyway, so again, I go into much more detail in the book, but you know, it was our view at the time that, and I say this from the perspective, you know, I remember I had the conversation with Tim Geithner, he was the most most hawkish about trying to save firms of anybody. Right. And, you know, he said, you know, we have looked everywhere, we cannot find a way to do this. So it was in fact unavoidable. And we knew, I think maybe it was worse even than we thought, but we knew it was going to be a huge problem. Yeah. And we reacted to that on the same day, on Sunday, by expanding our willingness to take as collateral for repo financing essentially anything that was acceptable in the repo market. So we greatly broadened our collateral because we knew there was going to be a huge funding problem. Right. So that's the basic answer.
So those who say,
a lot more.
Peter Wallison and others who say that Lehman in fact did have the collateral, was a candidate for a bailout, you just say they're flat out wrong. The collateral was not sufficient.
Well, I mean, yeah, I think they're wrong, and certainly we believed at the time that they were wrong. And I think the ex post, you know, many of these securities have come back and their value has improved, but you know, the losses in bankruptcy to Lehman by the creditors are hundreds of billions of dollars. And this was even, there were things going on in Lehman's accounting we didn't even know about at the time, like the Repo 105 transaction. So I don't think, it wasn't even a question of legality. I don't think it was feasible. Now, you know, again, I'm relying to some extent on what I was hearing from Tim and Hank, you know, from New York. I was in Washington, but we certainly were, you know, there were discussions. With Bear Stearns, there were phone calls with many people on them which said, you know, should we do this or not? We think it's necessary. How would we do it? And so on. With Lehman, there's no such phone call because we never had we never sort of were in a position where we said, okay, we have to decide yes or no. We never got to that point.
Yeah. In the book, one of the hardest decisions you make is the decision to bail out AIG, and there's you know, an excellent discussion of how you sort of held off on the press release till the last possible moment until Michelle Smith came in and told you it's time to push the button. Talk to us quickly. We're running low on time, but just how hard was that decision to make? What went into it? And what would have happened had you not saved AIG?
Well, you know, it was an incredibly hard decision. I'll tell you a story about it in just a second, which, because we knew it was going to be a political disaster, and it was. AIG was the gift that kept on giving. You know, after the bailout, there was bonuses and all these other things that happened that really hurt the Fed and hurt the bailout and the stabilization effort, you know, very seriously. So it was a really costly action. But here we have, you know, after Lehman's collapse, the financial panic went into huge, you know, into almost complete cardiac arrest, you know, the economy and the financial system. So here we had $1 trillion insurance company that had connections to financial institutions all around the world, and we thought this would just pretty much knock the lights out. So we thought it was really important, but even so, it was a close call because it was really tough to make a deal that we thought would work. And I remember Paulson and I went to an ad hoc meeting of Congress, and we were explaining to them, Bush accepted this, and he sent us to talk to Congress. So we went to Congress, we met with the leaders of Congress and of the financial and banking committees, and we explained what we were going to do, and we took their questions, and you know, tried to be reassuring, and at the end of it, Harry Reid said to us, he said, Mr. Chairman, Mr. Secretary, he says, I want to thank you for coming down here and explaining this to us. It was very helpful, appreciate you taking our questions. He said, but I want you to understand one thing. He said, nothing that you've heard here tonight constitutes congressional approval for what you're about to do. He said, this is your decision, this is your responsibility. And I'm thinking $85 billion. So it was very scary because basically Congress said, we're washing our hands of this. This is your responsibility. But, you know, I was absolutely confident at this point, and I think the facts bear us out, that if AIG had collapsed on top of Lehman, that, you know, we would still be digging out of the financial system. So we did what we had to do, and, you know, ultimately we did get the system working again, but it was a very tough time.
Yeah, we're running low on time. A couple of speed round questions. A, what happened to the Washington Nationals this year? That's your team. B, would you be interested in being baseball commissioner in the future?
Well, on the second one, yeah, absolutely. But you know, Rob Manfred, you know, they just made a transition and they have a new commissioner, and I think he's a very solid guy. The Nationals. So my story in the Nationals was meeting Jason Worth. Right. You know, Jason Worth in batting practice. Yeah. Jason Worth
tips his cap to you at games.
Tips my cat at games, yeah, but he's this tall, you know, rangy-looking, bearded guy, you know,
looks very like lumberjack.
Scary lumberjack-looking guy, and the manager took me up to meet him and said, Ben, I want you to meet Jason Worth. Jason says, hi, and he says, Ben's the chairman of the Federal Reserve, and Jason says, oh, yeah? I said, yeah. He said, so what's the deal with QE3 anyway? It was a very broad interest in monetary policy.
Yes, yeah.
But anyway, no, they just had, I mean, the Mets turned out to be really impressive.
Yeah, and, I meant to bring up the Mets.
Yeah, and
Daniel Murphy, break up Daniel Murphy.
Daniel Murphy, yeah, they should.
Is he too big to fail right now?
He is, and the between injuries and poor performances and bad luck, you know, That's why they play the games, as they say, right?
Yeah,
so,
right. Now, no, we should end on a fun sports note, but I'm instead going to ask one more really wonky question because it interested me in the book, your discussion of NGDP targeting as a potential framework for the Fed as opposed to inflation targeting. And it sounded like you really thought it was a reasonable approach, but would be politically difficult, particularly in a time of crisis, to explain and put into place. Do you think that has a future, targeting a growth rate rather than an inflation rate as a way to manage Fed policy?
Well, it's very intriguing because in models it works quite well, and the reason it works well is because under nominal GDP targeting, when the economy is slow, then the Fed temporarily targets a higher inflation rate, so it's a more counter-cyclical kind of policy. But I'm not willing to endorse it necessarily because it does require a huge amount of credibility. It requires the public and the markets to understand this more complicated strategy, and for them to believe that it's going to be followed for years into the future, no matter who becomes chairman, no matter who becomes president. So I'm not sure yet. I think that's a really interesting thing to study, but making the transition to that approach and making sure that it is sufficiently credible and supported enough and understood well enough is still pretty problematic to me.
Yeah. Before we go, tell us, what was the scariest moment of the crisis for you? I imagine it was Lehman weekend or somewhere in that area. And Hank Paulson, tells the story about how he believed we were not very far from, red lines and ATMs failing to give out money, and that he really worried that there would be a complete collapse of the system. Did you have that same view? And at what point did you have it? Was there a dark night of the soul?
Lehman weekend was really Lehman week because you had Lehman, Merrill Lynch, AIG, Goldman Sachs, Morgan Stanley, Wachovia. I mean, all these big firms were on the brink in this one very short period of time. And I knew enough about financial history. I just gave a lecture yesterday about financial panics at Princeton. And historically, all the evidence is that when you have a huge financial panic, the economy goes totally into the tank. And the recent research by Blinder and Zandy and by the White House CEA and so on shows that at the very beginning of this process in 2008, early 2009, the declines in the economy were worse than in the Great Depression. So I thought it was, and I think the facts bear out that it was extremely dangerous for the economy. And that period in September, October of 2008, we were very uncertain as to whether or not we could get the thing under control. It was very scary.
Yeah, very good. Okay, we're running out of time. I want to say it's time to wrap up the conversation. Thank all of you for being here. Thanks to everyone who joined on the live stream. Thanks, of course, to NASDAQ for hosting us for this interesting conversation. And we'll look forward to Ben Bernanke tweeting about the Mets victory coming up. Thank you.